Welcome to Trends with Benefits, a podcast by Van Eck with a forward-looking perspective. We explore new ways of thinking about the markets, investing, work, and life. Here's your host, Ed Lopez.
Welcome to another episode of Trends with Benefits. My guest today is Andrew Lane, Director of Research, Index Strategies at Morningstar, an important partner for Van Eck as we have introduced and talked about moat investing in general. It's an interesting strategy. It's an interesting approach to investing that, I have always thought exemplified the basics, the real kind of basics of how to approach investing. It's kind of just old school investing, but it's really brought up in a systematic rules-based approach that Morningstar has really honed and crafted over the years. Andrew, I think you recently started as Director of Equity Research, right? Previously, you were on the equity research team.
That's right. I've been in the equity analyst position in various roles at Morningstar for nearly the last 8 years, and recently started spending a lot more time with the Morningstar Indexes team, building unique, differentiated index strategies that pull IP from our equity research team, right? So we're increasing our collaboration between the equity analysts at Morningstar and then the indexes team and building some really interesting strategies using all of the research and ratings that our equity analysts produce. And so I'm spending more and more time, in that regard, working with equity analysts.
Andrew, I'd love to talk about origin stories and where people came from and what their thought process was, how they became successful in their career. I'm going to start out with one basic question, which was, what was your first experience with investing?
I think investing is something that always appealed to me because I've always loved working with numbers. So, when I was really, really young, I loved sports cards, baseball cards. I used to go into my living room at home and spread out hundreds of baseball cards on the ground, and I'd sort them from low to high by batting average, and then I'd collect them all, and I'd sort them from low to high by home runs last year, and I'd collect them all. And so as incredibly nerdy as that sounds, I think I always sort of enjoyed working with numbers and working with statistics. And that's where I sort of became interested in investing. I was like, okay, well, I can take this affinity for numbers and apply it to a career. And that was very exciting to me. That's sort of, I think, where the origin of my interest was in the broader world of finance and specifically equity investing. My first job out of college was with a firm called Harris Associates in Chicago. And I think where I really specifically started to get interested in being an equity analyst was, I worked in the trading room. All the portfolio managers would put their trades through through the trading room, and our job was to just make sure they were executed as efficiently as possible. And I found myself worrying less about efficient execution and wondering more about why were these portfolio managers buying and selling these stocks in the first place. So I'd see these trades come in, I'd start to look at the companies, and that's when I realized I really wanted to be an equity analyst or really just a stock picker.
How important do you think that is or was for you? I mean, to be able to not only just learn it academically, but actually put it into practice and, report on it like we actually do in real life.
Yeah, I think that's the beauty of the program. I think you just learn so much more when you have some skin in the game, especially the board meetings that we had to conduct, where the quote unquote board is a group of alumni. These board meetings were very intense. And so if you were underperforming or if you selected some stocks that weren't holding their own, you really got sort of taken to task for it. And so you knew as you were researching and picking stocks that you would be held responsible for the performance. And that just brings in an entirely different dynamic rather than just learning about investing in theory or, picking stocks and, hey, some work, some don't. And you don't really have to report back to anyone. And so that was an element that I thought was very important, much the way that for any young investor, I would suggest actually making some investments in stocks, just because sort of the viewing the gains and losses in your actual personal account helps teach you a lot of lessons you might not get from taking a look at stocks and seeing how they might have performed.
In your experience at Morningstar, I assume you probably had a role in hiring candidates. Did you find that many had that kind of experience, or are a lot of schools doing that now?
There are. So the University of Wisconsin program was one of the first a few decades ago when that program launched. It sounded pretty far out, right, to have students actually managing a decent sized portfolio of real money. But many programs have launched since then in that image. And so it is a a much more common model for graduate programs that are focusing on finance or investment. At Morningstar, I'd say a lot of the students that are interested in working in the equity research group actually now do have, that sort of experience on their resume at some sort of an educational institution.
So, what's the governing body of the equity research team? I know you have the Moat committee. Is that the board, if you will, for the equity research analysts?
Yeah, so the way that our equity research team is laid out, the team is based out of Chicago. So I'd say roughly 2/3 of our more than 100 analysts are based out of the Chicago Morningstar headquarters, and then we have smaller offices, based around the globe. And so the way that the group is sort of broken out is that we have our analysts broken into sector teams, and each of those sector teams has a sector director. The Morningstar Economic Moat Committee is another really interesting element of sort of what we do as analysts at Morningstar. So the Moat Committee is basically the oversight group that tries to ensure we have internal consistency across all of the economic moat ratings that we assign to companies. And just real quickly, what is an economic moat? So an economic moat is an assessment as to whether or not a company has a durable competitive advantage. And if so, how long lasting will that competitive advantage be? So for every stock we cover, it either has a no moat rating, a narrow moat rating, or a wide moat rating, with a wide moat rating being sort of the cream of the crop in terms of companies with long lasting, durable competitive advantages. An analyst, doesn't have the right to just sort of apply a moat rating and publish the company. Instead, we have a thorough oversight group called the Economic Moat Committee that I used to run for a handful of years. And it's a group that basically sort of tests the logic and debates a proposed moat rating with an analyst before the analyst is at liberty to launch coverage of a given stock with a given moat rating. So the Economic Moat Committee is a group of, about just over 20 of some of our most experienced analysts who have been, in the department for many years and have just a strong knowledge of our economic moat methodology.
Yeah, I like the way you guys define a moat, wide, narrow, and what have you. When you think about it, let's see if I get this right. You think about a moat, or if you think about an industry or a company in an industry earning profit, a large amount of profit, it's going to attract competitors to try to actually gain some of that share. And so the idea of a moat would be how long can they fend off competitors, or how long can they defend the profit, right, until down to a certain break even?
Yeah, I think you've phrased it quite well. So I guess the underlying assumption beneath our economic moat methodology is that quote unquote capitalism works. And what I mean by that is that if a company is profitable, it will organically attract competition. In turn, that competition will erode the profits over time of the incumbent. And then in turn, again, lower profits for the incumbent would gradually weaken investor or shareholder returns over time, right? So we view that as an inevitable process. It's not a matter of if that'll play out for a given company or industry. It's just a question of how long will it take for that to play out. So no company is immune, right? No industry is immune. But that's where the economic moat comes in. The economic moat, if a company does have a moat, it does have a durable competitive advantage. It can delay that process for sometimes decades. The economic moat simply delays the pace at which that inevitable quote unquote capitalism works process plays out. And those are the types of companies that in turn typically provide solid investor returns as well for longer periods of time.
And what are some of the characteristics of a wide moat? Because I'm assuming that the analysts are making judgments about different areas and aggregating that to determine what that moat should be.
Yeah, so there are really sort of two parts to a compelling moat argument, right? To an argument that a company does have some sort of a durable competitive advantage. I already sort of mentioned the quantitative aspect, which is that we would need to have conviction that the company's returns on invested capital will remain above its weighted average cost of capital for a certain number of years, right? So for a narrow moat company, that would have to more likely than not be true over the next 10 years. For a wide moat company, that would have to be more likely than not to hold true over the next 20 years. So that's the main quantitative metric that we're looking at into the future. But then the qualitative evidence has to be there as well. And for that, we have 5 specific moat sources. We have network effect, right? That's the virtuous cycle moat source, where as the network grows, its value increases for new and existing users. Then there's intangible assets. That's often brands, patents, regulatory approval, very clear barriers to entry from would-be competitors. Cost advantage is another, and exactly what it sounds like, right? A company simply has more attractive cost of production than their competitors. For wide moat companies, economies of scale is typically the main driver of cost advantage. Switching costs is another moat source. That's where the cost of switching to a new supplier or provider is actually higher than the benefit that the company would get in making that switch. And it's not always purely a financial consideration in terms of just the cost of the solution, but also implied risk in making that switch, right? Loss of data, disruption of business operations, machinery downtime, right? The implied cost of failure if something does go wrong. Those all factor into switching costs as well. And that provides pricing power for your incumbent supplier that sort of has a hook in you as a customer. And then lastly is efficient scale. Some would sort of call this the natural monopoly moat source. And this is where an industry is efficiently served by just one or maybe a small number of competitors. And maybe, those companies or that single company earns a very thin economic profit spread. And there's not so much of a definitive barrier to entry here other than just basic economics. If a new competitor were to come in and compete for that thin layer of economic profit, it might destroy value for both companies. And so that disincentivizes would-be competitors from coming in and trying to take market share.
And then I guess to complete the discussion about moat stocks and the Morningstar process, maybe you can spend a little time just highlighting fair value and how you guys assess value given the moat evaluation.
Yeah, and I think this is a really unique element as well of our broader methodology. It's not as though we assign moat ratings over here, and sure, they're interesting to talk about and debate, but then separately, we have an entirely different process for valuing a business. The two are very much interrelated, the moat ratings and the valuation. Depending on what moat rating we ultimately choose for the company, that has a direct impact on how we value the business. And that happens a few different ways. So we use a three-stage financial model to value a given business, and all of the research we do behind competitive advantage that influences how we model the financial statements of the company in the kind of stage one of our model, but it also impacts stage two, which determines how long a company can be expected to earn excess returns. So if it's a no moat business, well, really, there's nothing protecting the business from would-be competitors. So if there are attractive returns on capital, they'll fall down to the cost of capital very quickly. There is this, linkage between the analysis of competitive advantage that we provide and then fair values that we provide. It. If I were to phrase it one other way, if we were to take a given valuation model and we were to downgrade the moat rating, let's say from wide to narrow or from narrow to none, our fair value, all else equal, would actually decline. So there is this very clear, inextricable linkage between the two. But ultimately, at the end of the day, when we value a business, we are issuing a fair value estimate. And that is our assessment of really just what the business is worth today. Again, we use a traditional, although very comprehensive, discounted cash flow model to come up with our fair value estimates. And it simply discounts all future free cash flow the company will generate. And in today's dollars, that's what the business is worth.
So let's talk about the Widemode Focus Index, because you recently wrote a white paper on that. Talk a little bit about the white paper and the impetus around writing that piece.
Yeah, sure. Absolutely. So as part of my role working with our indexes team, I do publish occasional white papers with a focus on the Widemode Focus Index. And so this most recent white paper was a 2020 year in review. It was a unique environment. And it was a year in which the Widemode Focus Index underperformed the broader US equity market, which broke a 4-year streak of outperformance. And so I wanted to take a close look at what had driven that underperformance and what headwinds were at play. And just in short, I think something that was key was the fact that the index was very underweight the FANG and Microsoft stocks, or as some would call it, the FanMag group of stocks. So for the benchmark, which is for us the Morningstar U.S. Market Index, has a pretty high correlation with the S&P 500. Those 6 stocks they accounted for about 19% of the weighting of the benchmark, but they were close to 5% or so of the weighting of the strategy. And in turn, with that group of stocks providing really narrow market leadership over the course of the year, big tech performing very, very well, driving a good chunk of the broader market's returns, that was a very notable headwind. And in looking at performance attribution, the underweight to those stocks alone pretty much explained the magnitude of underperformance that we saw. One other key consideration would just be that the Widemode Focus Index, as I said, sometimes it leans a little towards growth, sometimes a little towards value. In 2020, it had a little bit more of a value bent, and I think it was a little bit early in terms of moving into that position. So, it leaned a little bit towards value, and then early on in the year, and then over the rest of the year, growth soundly outperformed value. So we're still confident that a lot of the stocks we added during 2020, we were able to add at really attractive valuations, but sometimes it takes a little more time for some of those valuations to be realized.
Now, I know the white paper looked at just 2020, and you referenced the 4-year streak that it had. And it's performed, the index has performed really well against the broad markets, even given that it's been, I guess I call it traditionally underweight the high momentum tech stocks that have been out there. Is that right?
It is. And that's something that we're really excited about. So of course, being underweight big tech in 2020, as I mentioned, was a pretty pressing headwind. But, we've had other periods of time over the last 5 years or so when the strategy soundly outperformed, but big tech was still driving a good chunk of the broader market's returns. And so in some of those years, stock selection more broadly was able to offset a headwind from, being underweight the FANG and Microsoft basket of stocks. And so, it also is just a reflection of the importance of valuation. 2018 is a great example where big tech was sort of leading the way for much of the year. And the Widemode Focus Index was performing roughly in line with the broader market entering the fourth quarter of 2018. And that's when the so-called tech wreck came home to roost. And so that was a quarter in which big tech experienced a violent shakeout. In that year, we had been underweight big tech for most of the year. Again, not because we don't like those companies, but simply because we felt from a valuation perspective they'd gotten a little bit out ahead of their skis, and so we were very underweight big tech entering the fourth quarter. And then, of course, that was a favorable relative positioning given what happened in the fourth quarter. So that actually was probably one of the better quarters of relative performance we've ever seen. And so that's why valuation remains important, right? It's tempting to just sort of own broad market exposure, own broad exposure to big tech. And, if so, that's certainly served investors well more often than not in recent years. But, it doesn't always serve investors well. And it's important to still keep an eye on valuation.
Are there any interesting picks in the Widemode Focus Index that you think are really neat to highlight?
Yeah, absolutely. And I always, enjoy bringing up a couple stock stories because I really think it helps bring our broader methodology to life. One company that I'm very fond of is a stock called Compass Minerals, right? And so while the Widemode Focus Index is comprised of a lot of, large or even mega cap, well-known companies, there are smaller companies that, when the conditions are right, can garner a Widemode rating as well. And Compass Minerals is one of those. So it is primarily a miner of rock salt, and for the most part, that rock salt is refined into highway de-icing salt. So ultimately, volumes are very closely tied to snowfall, particularly in the Midwest. And this is a company that is a commodity producer. For a commodity producer, these companies have no pricing power. Obviously, they sell commodities. And therefore, it's very rare for a commodity producer to actually earn a wide moat, right? Effectively, the only way to do so is to have a very compelling cost advantage versus competitors. And cost advantages, particularly with commodities, can be very fleeting. But Compass Minerals is just a great example of one of these commodity producers with no pricing power whatsoever, but a very interesting, attractive cost advantage. So it has its flagship rock salt mine is called the Goderich rock salt mine, which is located in Ontario. It's a unique geological asset that obviously is impossible to replicate. The geological advantage comes from the fact that the mine has salt seams that are 100 feet thick, and that compares to other competing mines where the seams of salt are only 20 to 30 feet thick. So in other words, for each foot you advance in the mine, you're getting a multiple as much salt as you would at mines operated by competitors. So that speaks to the geological advantage in the first place. But then there's also a really dynamic transportation cost advantage as well. This mine happens to be located right on a deep water port on Lake Huron. And what that means is that the salt can get mined, put right on a barge, and taken to all the major cities located on or near the Great Lakes of the Midwestern United States. So salt has a low value to weight ratio. So it can't really be transported very far before it's not economic to do so. Compass can actually put the salt right on these barges. That transportation cost is about half the cost of transportation by rail and about a fifth of the cost of transporting the salt by truck. So you have these unique mining costs combined with a transportation cost advantage. And given that the mine life is still decades long, this is an asset that underpins a wide moat rating for that company as a whole.
What do you think is the most common source of moat that you find in companies today?
Yeah, so intangible assets is safely the most common moat source, and again, that's going to come from a patent or a regulatory approval or a brand, right? Brand equity is which in turn provides pricing power, is a key form of intangible assets. The least common is actually network effect. That's that virtuous cycle moat source I was talking about before. So network effect, it's very difficult to build critical mass for a network that can be heavily monetized. Often network effect does apply to winner take all markets. So for example, MySpace, I guess there wasn't enough room for MySpace and Facebook at the same time, right? Facebook built a more compelling network effect than MySpace had offered, and therefore users migrated over to Facebook. And so that's the least common network effect, but it does typically lead to the highest, returns on equity, returns on capital for the winners of these winner take all markets.
All right, let's talk about kind of the current market and the current market craziness over the last decade or so. Do you think valuations matter in today's market?
I would say that a core tenet of what we do and how we think about the market at Morningstar is that valuations always matter, right? And so I know that when it comes to trying to justify some of these valuation multiples that a lot of very popular stocks have these days can be very difficult. But ultimately, when you look at a long enough time horizon for how a company is going to perform into the future, I think you can justify a lot of the multiples that some would say, make no sense or have to be thrown out the window, right? So, for example, a company like Uber famously, has had massive losses for numerous quarters. How's the high multiple at which it trades get justified, right? It's burned a lot of cash over the last few years. But when we're thinking, does the company have an economic moat? And we believe it has a narrow moat. We ultimately think it has a very powerful network effect, and the ability of the company to monetize that network effect will ultimately be much stronger a few years down the road than it is now. So the multiple at which it's trading, now on this year's earnings or next year's earnings isn't nearly as relevant to us as looking at what the company's ability to generate free cash flow will be down the road. And we think it's a compelling stock in that regard, right? So the network effect is in place. Ultimately, it'll be monetized much more efficiently and effectively than it's being monetized today.
What's one long-term trend you see playing out over the next year or several years?
A trend that I'm really interested in is the adoption of electric vehicles, and then also technological inroads to facilitating a greater degree of autonomous vehicles. One reason that this is interesting to me is that I have two sons aged 1 and 3, and then we have another child on the way here in just a few months. And I often wonder to myself if any of them will ever have to drive a car. In the next 13, 14 years, will autonomous vehicles evolve enough such that my own kids would never actually have to drive a car? What's really nice is we have published an incredible amount of research on that broader theme at Morningstar. So one of our really talented analysts, Seth Goldstein, he is the chair of our electric vehicle committee, right? So they have a regular publishing cadence on this theme and looking at it from different angles. So he's produced an incredible amount of really cutting edge research on the topic. And the other interesting thing about this theme and a reason that I like it is that, the development of electric vehicles really impacts a surprising number of industries, right? So two of the ways that we've always enjoyed advertising ways to play it is lithium. Our two top picks there historically have been Albemarle and SQM. They're both very low cost lithium miners that are in the middle of significant capacity increases for the production of lithium. Lithium, of course, is a necessary material to create the batteries that power the majority of the electric vehicles out there. They both had quite a run up recently, so they're not as attractively valued as they had been just a few months ago, but nonetheless, very interesting companies. And then utilities is another interesting way to play the EV theme or trend, right? So companies like Edison International or Sempra Energy, they should benefit in providing the grid from California's goals to ensure that there's great adoption of zero emission vehicles in the coming years. So just a couple of industries that this theme touches, but it really touches, so many more as well.
What do you think the odds are of getting more federal government support for building out green infrastructure?
Yeah, I would say it's very high. I think it's very high. China is actually doing an incredible job on that front. Also in Europe, certain countries have made incredible inroads already at facilitating EV adoption. I'd say the U.S. is a little bit behind the curve in that regard, but I do think we'll be seeing a lot of changes from a policy standpoint in the coming years that will continue to catalyze EV adoption.
All right, ready for our speed round, trend or fad?
Sounds good.
Zillow surfing, trend or fad?
Fad.
SPACs, trend or fad?
Fad.
E-learning, trend or fad?
Trend, without a doubt.
And cryptocurrency, trend or fad?
I will admit that I go back and forth on this one with incredible frequency, and I'm currently in the trend camp. However, the specific type of cryptocurrency that ultimately gains the most traction or the group that does, I think is still yet to be determined.
Yeah, still a lot to learn in that field for many people, and myself included. And that's actually a great segue to promote one of our other special series that we're doing on Trends with Benefits. We're doing a special Bitcoin series where we spend a few different episodes talking about the way Bitcoin works, how to trade it, how to invest in it, and really understanding it. So check it out yourself.
I will tune into that because I'm tired of waffling back and forth internally here on whether it's a trend or a fad.
Thank you so much for your time today and sharing your insights. What's the best way for people to connect with you?
If anyone does want to contact me directly, you're welcome to do so by email, andrew.lane@morningstar.com. And, if you have any questions about Morningstar's broader equity research offering or the Widemode Focus Index specifically, please don't hesitate to reach out, and I'll be happy to chat.
Thanks, Andrew. It was great talking to you.
You too. Thanks a lot for having me, Ed.
And thanks for tuning in to another episode of Trends with Benefits.